You're listening to The Dealmaker's Edge with A.Y. Strauss, diving deep into stories behind commercial real estate leaders. Hello, everyone, and welcome to The Dealmaker's Edge. Today, we are very excited and honored to be joined by the one and only Ezra Stark. And he is obviously the CEO of Stark Enterprises, which was founded in 1978. Robert Stark, and it's a full-service commercial real estate development firm focused on mixed use, retail, office, student housing, and parking facilities located across 7 states. As CEO, Ezra has grown Stark's footprint to include over 9 million square feet of Class A commercial properties that have a current valuation of over $2 billion. Before being tapped in May of 22 for the CEO role, Ezra held several leadership roles at Stark, including Senior Vice President of Property Management and later as COO. Ezra is a critical voice in the commercial real estate industry and regularly speaks on panels across the country, sharing perspectives on the market, investment, and what's coming in his From the Desk of the CEO online article series. Ezra is a member of the ICSC and many other organizations, recognized as Crane's Cleveland Businesses 40 Under 40, graduated from Brandeis and NYU, their MBA program. And Ezra, it's really, really great to see you, and thank you so much for taking the time to share some thoughts today.
Pleasure. Thanks, Aaron.
No, I read those bios and I'm just nervous I'm going to mess them up, but hopefully we didn't botch anything there. It's great to have you on. Well, I guess, you grew up in the real estate business. You have a ton of deals going on. You have a lot of perspective, and we could take this any number of ways. What I love to do to start off is sort of walk people through the background. You went through a lot of steps in your career and you've seen a lot, but maybe you could talk about, just sort of growing up in the business. You joined the family business really right out of college, but you could talk about sort of that jump from those younger years to that professional transition. That'd be really nice, I think, for people to hear about.
Yeah, sure. I kind of grew up around the dinner table learning about net operating income and cap rates. So it definitely is in my blood, and probably definitely gave me a competitive advantage learning at the feet of my father in terms of the real estate world. And even at the early age of 16, my father it was a tradition, and me being the oldest of 4 kind of started that tradition. He would take us to the National Retail Conference in Las Vegas held by ICSC. And even at an early age, to be able to be exposed to having, one-on-one meetings with CEOs like from Barnes & Noble or even Walmart at the time, to see that when you read about them, they sound like these mythic gods, if you will, these legendary people, and there can be a real intimidation factor. But to kind of normalize, to kind of humanize them by being exposed to them and seeing at the end of the day, all they're trying to do is if you can gain their perspective and see what they want from things and learn how to negotiate and deal make it at the highest level, it was an incredible experience for me. And I was able to be a sponge and just shadow there and really just learn and observe. That was a real incredible advantage growing up. Then where a lot of kids would go work at summer camps, I was always into real estate. I loved the idea of being able to, unlike in Wall Street where a lot of my friends were going, where things you were creating were just on spreadsheets and it was all numbers per se. I love numbers. I'm driven by them. But to be able to kick around the tires, if you will, of walking the land, of seeing the buildings, of seeing people interact with things that you're actually creating. There's just an incredible creative process that just pure finance didn't have. So I was always in love with it. My father always romanticized it, and I kind of drank the Kool-Aid. So then growing up, I would work for mortgage brokers, understand the finance component to it. I would intern for them in the summers. Then when I was even at NYU, I interned and worked at Forest City Renter prior to them getting acquired by Brookfield. And so I learned, and this was at the height, this was right before the Great Recession when the real estate bubble was right at the peak. And I learned a lot of things of potentially what not to do, because we were in the middle when I was working at Forest City. They were doing the Brooklyn Nets project in Brooklyn, massive project. I learned a lot from that. Worked on the project in Yonkers, New York, which was kind of a mixed use lifestyle center. I'll never forget when I was looking at that deal, because they had some issues with that deal, but I remember somebody who I was reporting to was performing at the time, $50, $80 rents, and they had second floor space. And they're like, well, this is New York. And I'm thinking to myself, well, Yonkers is in New York. And I probably didn't say it I had a lot more swear words at the time. I'm way too prone to use the F word, but I'm going to behave myself on this podcast so that my kids can watch it. Although they probably hear me slip that sometimes. But to
That's awesome.
My wife's dismay. But so then again, talk about being thrown into the deep end at the beginning of my career. We're talking 08, 09, finishing my master's at NYU, and then looking to contemplate staying in New York, but then the Great Recession hit, and I'm like, you know what? I'm going to come back home and work with my father and figure things out at the time. That's kind of the genesis of how I got to start.
That's a great backdrop, and I appreciate that. And that sounds like you had a lot of really fun conversations internally. But then stepping into the family business in 2010, maybe you can describe that, because the whole world froze. I mean, you had low liquidity. I mean, it was an unmitigated disaster. I guess 08, 09, 10 maybe started to stabilize a drop, perhaps. But maybe talk about, I think there's a real benefit to starting at the bottom of a market, so to speak. And maybe you can talk about how the company felt when you first joined from a macro perspective. It was around a long time, but...
Yeah, no, but there was a tremendous benefit to it, because the lessons I learned from that period of time has positioned ourselves to an incredible position of strength right now. Now, there's a lot of differences between the current high interest rate environment versus literally no debt or equity, no liquidity in the marketplace. But at that point, it was an existential crisis. And here we're now in a position to hopefully take advantage of a distressed marketplace with dry powder. So yeah, to be in an environment where there is no debt or equity available in that period of time, you learn the importance of just healthy balance sheet. There's a lot of people, again, it depends if you're a long-term owner of real estate versus a short-term. So a lot of especially leading up to this, I call it recession, but I think it's going to get worse still. But leading up to this period of time in the present, it was very trendy and on trend for a lot of syndicators to put together a lot of these deals with very little skin in the game, and that they were hoping jack up the NOI and flip it for a quick return and get their fees, because they were really driven by fees. The challenge with that is, again, and you need to get as much leverage as possible to reduce the equity to jack up your returns. And because debt was so cheap a year ago, it worked financially. But we stayed away from it, because what I learned was the biggest, most important lesson in real estate is flexibility. Because everything you think you plan, every performer, everything looks great, everything won't go according to plan. And because real estate is such an illiquid asset, because there's so many covenants, whether it's leaseholds by various end users or by your lenders, you're already working within a tight box and framework to be able to problem solve. And if you can contemplate as much as you can upfront and create the flexibility in all your documents, and also just as importantly, your capital stack. I learned I would never do mezzanine debt or preferred equity anymore, because it's all great, looks great on pro forma. You just juiced up your multiple by 2x. But if you miss, and COVID was a great example, you could do nothing wrong. You could have the right NOI cash flow. But all of a sudden, let's say if you owned a retail asset and your retailers didn't pay for 3 months, all of a sudden now payments accruing. And that's at a way higher interest. Well, at the time, higher interest than what your debt was. And so that can bury you, so that even though you have an underlying extraordinarily healthy asset and performing great, your investors are screwed. And so learning early on in my career, the utmost importance of downside protection, principal protection, making sure that you have a healthy, more conservative traditional capital stack, as well as building as much flexibility with your lenders as possible, is worth its weight in gold. And those are most of my main takeaways from starting my career, during the Great Recession.
That's awesome, and really well encapsulates sort of the GFC all the way through today and everything mixed in between. And it seems like you're extraordinarily well positioned for whatever's next. And it's going to be interesting to talk about that too. You've also been in growth mode. I mean, when we've spoke before, you have a lot going on. You have a lot of development. You've embraced the Sun Belt. I mean, you're across 7 states, maybe even more states than that now. 10 states, apologies. So the bio does stand corrected. They're outdated with guys like you. I got to say, it's a good problem though. Maybe you could talk about, how you got to that fast growth. Obviously, time to true principles. You grew up in the business. You have a great brain for it. You have a great heart for it, and a great starting point for it too. But you have also had to really expand the company, and you really put the engines on when a lot of sometimes, next generation is more inclined to just be super conservative. So you've had to walk this fine line between saying, let's build and grow because diversification is a healthy thing. You were sobered by going through the Great Recession, but yet you've also managed to push the growth, and that's hard to balance. Maybe you could talk about, obviously this year is its own year separate and apart, but maybe those years, the last 36 months preceding, I mean, you've had so much stuff going on, and talk about how you've envisioned that growth.
So the other thing was, I think another lesson that I took away from the Great Recession was everything's cyclical, right? And where a lot of public REITs, because Wall Street or somebody in the cubicle says you need to pick a specific niche and stay with it, it really exposes you to that specific asset class. And being a private firm, I said, we don't need to follow those rules. So my father, growing up, he emphasized and which was great. And as a child, I appreciated it. He wanted to be at all of our sporting events, me and my 3 siblings, and kind of created this self-imposed race restriction to be home at night. And so really didn't venture mostly out of Northeast Ohio, if you will. And as a result, again, just due to his sheer brilliance and creativity, had to go from shopping centers with Walmart to Section 8 housing in Erie, Pennsylvania, if you will. But he really was mostly focused on retail, and we were mostly focused in the specific Northeast region. And it was mostly just internal family fund. So one of the things that I wanted to do was, again, diversify geographic, asset class, and investment goals. So we focused and created a whole capital markets division, which we have a great now stable of family offices that now have been with us for over 10 years and have invested in multiple projects. Again, we're super relationship focused. And in addition to that, we diversify to student housing, multifamily, as you mentioned, and other, thank God not office, but other asset classes that, again, so that if retail was down, multifamily was up and vice versa. So you had a more balanced, healthy portfolio. And again, it allowed our investors to stay with the same sponsor, but to have also a more balanced real estate portfolio. So that was something we really focused on in terms of diversification. In terms of growth mode, my philosophy is if you're stagnant, you're kind of dying. There is no such thing as stagnation. I think even when people retire, you see some erosion of brain or capacity. It's not necessarily the healthiest thing. Even if you are a billionaire, to stop working at 50, the brain's a muscle, right? But I think that that's just in general in life, that if you're not always advancing, just here's an analogy. If you're swimming in the water, even to stay in the same place, you still have to tread. So you're actively moving, you're actively progressing, even if you want to stay in the same place. If you stop moving, you drown. I think that that's a great analogy for life or for business. And so I was always trained and always had the growth-oriented mindset. And so we apply that to the business. It's also just fun and to be able to continue to be driven by wanting to be creative. And under development in the portfolio, that was just on the retail side. We're closer now to $4 to $5 billion, depending on where cap rates are, because we've now really expanded our build for rent and residential sector as well. It's been quite the journey. And again, you were asking about how are we approaching now? How are we still in growth mode when most people are circling the wagons and kind of waiting and seeing? Well, we're kind of taking a dual path approach. On the acquisition side, we were not active for the last 4 or 5 years because we couldn't make sense of the 4 cap rates in tertiary markets. When I started my career, that's where Manhattan was in cap rates. And then when I'm seeing 4.5 cap rates in Toledo, Ohio, I'm like, this doesn't make sense. And again, it was more of the syndicators driving these crazy valuations because they were playing with other people's money and they were really focused on the fees aspect. And they were playing with historically low debt that also was not sustainable. So we acquired some retail at the time, which was a contrarian view because everyone said Amazon's going to kill retail. We were able to achieve those at 8 caps even, 5, 6 years ago. And so those have been performing very well, providing double-digit returns. But we stayed away from the multifamily because we thought it was just way over. And again, you feel kind of dumb because a lot of the people in the middle, everyone looked like a genius up until a year or two ago. So you're like, well, what are we missing? Maybe we're wrong. But again, it was that discipline. I think I really do credit starting my career, the Great Recession was, yeah, I might be able to gamble, make it, but it's not worth it because I know the shoe's going to drop at some point. And sure enough, it did. So the other thing that we pivoted on the development side was traditionally where my father had positioned the firm originally was doing a lot more larger scale in terms of scope, if you will, and a lot of urban infill projects. The challenge that we were coming across was that municipalities had become harder and harder to work for majority of them, especially in the urban cores. And so what used to take, let's say my father in the 80s or 90s, a year or two to develop would now take 5 to 7 years. And so that was a big opportunity cost question mark. And again, even pre-COVID, we were questioning what's the migration of the urban core and what's the value. So what we said was, we thought the recession, we were wrong. We thought the recession was going to happen sooner. Then COVID hit, and COVID, obviously, with all the money being pumped in the system, delayed this recession for 3-4 years. And we're still not saying, we're not close to the bottom. But we said, how do we create a recession-proof model with governmental interference, okay, that was also scalable? Because the other challenge when you're doing urban infill, you're kind of having to recreate the wheel every time because the sites dictate various different needs. And so it's, again, really hard to scale. And if you want to be in a hyper growth mode, you have to think about whether it's real estate or any business, how do you scale? Scalability is everything. And so we said, okay, what if we created low density housing, a hybrid between multifamily and single family for rent? And how can we create a product type that would be single story, stick build, a very simplistic form of construction that has tremendous benefits from accelerated absorption because each building gets its C of O, certificate of occupancy, earlier, and therefore you can accelerate your lease up, versus if you build a big tower, you have to get the whole building completed before you put heads in beds. In addition to, let's say a contractor screws up electrical on the 13th floor, I kind of can't throw them off the job, whereas if they screw up in building number 3, you can go find another electrician because each building is separate. So there's just a lot of interesting benefits to it. And then the secret sauce was also, we were tired of always having to be in an arms race on amenities. The challenge is, especially even now, right? We have a massive labor shortage, which drove up labor costs and construction costs overall. So COVID created the material shortage, which was doubling, at one point, lumber was 3-4x, which was insane. But in addition to the labor shortage, so you already had a natural labor shortage and then the demand. So construction costs were really just skyrocketing. So everything that was being new construction was being luxury. And so they had to always get the top of the markets. And we said, that's great. But at a certain point, I don't care how much people are making, how much are they going to be able to afford monthly? There is going to be a cap. And people are performing $4,000, $5,000 a month. And we're like, that's not, the average American cannot afford that. And we said, whoa, how can we get this back down to $1,800 a month, $2,000 a month? Like, we want to be targeting middle of America where there's a tremendous housing shortage. And we want to provide a value proposition where we could provide somebody, a 1,200 square foot home, attached 2-car garage with aspirational amenities like a golf simulator, luxury swimming pool, pickleball courts, all these things that they would have to pay, all these extras that they wouldn't be able to afford, but all for the $1,800 to $2,000 a month, which would be cheaper than if they got a mortgage on a $250,000 home. And so again, we had a clear, concise vision of what we wanted to do. And then we backed into how do we execute that, which took us 2 years to figure out how to even execute the vision. But we first created, what do we want to do, which was recession-proof, targeting middle America, low governmental issues, things that were our must-haves. And then we kind of then started with that, and then we kind of backed into the vision.
Terrific. And I think unlike falling for that easy trap of just buying existing, which is, it's not a trap. A lot of people have done extremely well with it. Some people will not touch development. So to your credit, you went out of state, you put the gas on, you managed aggressively and conservatively at the same time. And if you develop, you can also, develop to a cap that can make sense. Sometimes that ordinarily would never make sense or be possible to buy with.
That's right.
Liquidity.
So it helped us on both ends. We were developing at a 7.5 cap, untrended for when people were buying at 4 caps. Now the 7.5 cap still will pencil out in this environment. We're not going to get the 2 to 3x on a refi, but all of a sudden now we're building now in this current environment that hopefully, God willing, the market will shift. And by the time we're fully stabilized on these projects 24 months from now, the markets will stabilize, the interest rates will normalize, and we'll achieve the right returns. But also, construction has come to a halt right now. There's very little construction. Again, we're trying to take a contrarian viewpoint here. And it's not just easy to say, oh, I'm going to take a contrarian viewpoint. You got to have the track record. To get debt in this environment. It's impossible, but we're blessed that we have really great partners within the banking world and that we've got a great track record and also do lots of business with these banks. But it is also good when you're taking contrarian viewpoint, when there's quote unquote blood on the streets, that's when you can really make tremendous value, because the rest of the competition, or the fly-by-nights, or the casual guys who you couldn't lose money by just buying apartments over the last 8 years or so, those guys go away because they can't do what they had achieved.
Absolutely. And maybe that's a good segue into the present day. And to me, it feels like it's almost like a tale of two cities. There's a wind blowing of people who want to just carry on doing what they're doing. And then there's these storm clouds and there's the distress. And it almost feels like two markets mixing together, or like, I joke, it's like the Harry Potter novels, like they just get increasingly dark as you get, further and further in. But maybe you could describe from your vantage point. I'm sure every day someone's trying to talk you into buying an asset. And again, you have to have that sobering from the GFC and have gone through obviously the last 12 to 24 months in this new market. But you talked about it still being early, and there's no way to perfectly time anything, right? And timing is all relative to asset class and your long-term investment horizon, et cetera. But maybe you could talk about what you're excited about. Obviously, you have a lot currently to manage and finish and carry on your business plan, but you've been doing this a while and you're a young guy, and hopefully there's many cycles in front of you. What's sort of exciting to you over the next 12 to 36 months, I guess I would ask?
Well, I am excited to continue the build for rent. I think it only makes like 1 or 2% of the entire multifamily in the US. I think that number should be closer to 25, 30%. So I think there's still a tremendous amount to do there. Some of the challenges is that home building is still doing tremendous. So we're still getting a tremendous amount of competition on land. Land is very difficult to find just because the home builders were competing with the Pulte's, the LNRs, the D.R. Hortons of the world, because home construction is not slowing down. There still is a shortage and people are still buying homes, even in this higher interest rate market. I don't think I would touch office. I think there's going to be, interestingly enough, we said, oh, Amazon would destroy retail, and it didn't. What we said was it would consolidate. I think that's true to office to an extent, but I think the difference is that there's going to be a fundamental shift. I think that hybrid working is here to stay. Having our couple hundred employees, I know that if we didn't provide that, it would be very difficult to attract talent. And so just by that, you're going to reduce 30% of office capacity in the country, let alone the fact that now you kind of are only scratching the surface because the leases are coming up, that the office people are all going to have just like the retailers have for the last 10 years, office users are going to have this leverage over office owners. And so where office owners could justify putting in the tremendous amount of capital X in these spaces because you were signing a 10-year lease, good luck getting a 10-year lease from an office user right now. So if they're always saying, hey, we only want 3 to 5 years, the office owner is desperate to keep it full, so they may do it, but you can't amortize those capital expenditures over that short period of time. And so I think office is on a downward spiral, death spiral, that I think, again, we haven't seen it because the banks haven't done mark-to-markets of the true assets. So there's going to be two things. I think banks are going to do a tremendous amount of workouts. So probably we should all short bank stocks, because at some point they're going to have to realize it, or they're going to take over the assets and then people are going to be able to buy them at a greatly reduced basis. So again, I can't predict when or where, but office seems very volatile right now. And I don't know if that's going to shake out within the next 24, 36 months. Again, multifamily, I think it's, like you said, the tale of two cities, or I guess the Harry Potter, the two different viewpoints. If you were a long-term holder, did long-term debt, whether it was agency or HUD, and you're fine because you can ride it out with the cash flow. The only exceptions to those rules are what we're seeing is in the South. So I don't know if you've addressed this with other people on your podcast, but like there's an insurance crisis in this industry like I've never seen before in my life. Somehow, based on the climate change and things like that, insurers have now completely overcompensated. And I'm seeing a lot of guys who are maybe having to hand back keys, not because the property is not performing, not because their debt's not healthy, but because their insurance rate's gone up 3 to 4x. We're talking from $500 a unit to $2,000, right? Just to give perspective, that's 1 month's of rent. So all of a sudden you were relying on 12 month, right? We all underwrite it as a 12-month asset. You've lost a month. You're now underwriting 11 months of rent because of where the inefficiencies are in the insurance market. So I think there will be either we're going to have to see government influence, legislation change, or some really awesome disruptor in the insurance space who's going to carve out the coastal areas or the floodplains, because there's no reason, for example, why I would be paying the same insurance rate in Orlando, Central Florida, where there are no hurricanes, when you're or on the coast of Naples, for example, or Fort Myers. And right now, those are the inefficiencies, where literally we would be paying the same insurance costs in Central Florida as you are coastal Florida. So again, this could be a 24, 36-month problem. People will go broke and hand the keys back on multifamily. I have a buddy of mine who has 2,000 units in Dallas. He's facing an existential, again, not on the corporate level, but on the property level, of not knowing what to do, whether to hand back the keys or not, because even in Dallas, and the main culprit of the insurance, just for people who are curious, it's the wind insurance aspect of it, which is actually the wind insurance of the overall property and liability makes up over 90% of the cost. So it's a crazy inefficiency market, but somehow they have this monopoly, people aren't bidding it, and it's just a non-competitive marketplace that's really impacting multifamily. That will impact people even with longer-term debt because it'll eat up all of their cash flow. The other multifamily people that will be in trouble are the ones that did like the bridge lending with the floating rate, hoping to jack up the NOI and then, do a refi exit. So we're seeing some of that. And right now, they're not handing back the keys. The opportunity for people with dry powder that we're like people like ourselves that we're evaluating are where I would never want to be in that position, but to be preferred equity kind of rescue capital.
Sure.
There's definitely opportunities with people with money now to be lending their money in ahead of all the equity and be making anywhere from 15 to 19% returns. But again, you got to be careful there. It's a dangerous place because, again, just to give perspective, if these guys bought these assets at 4 caps and based on where interest rates are, right, if it went up 25%, right, you've lost all your equity. If you go from a 4 cap to a 5 cap, it erases your equity. So that's great that you're, in theory, on paper, getting your preferred return. But what's your protection if they hand you back the keys? The equity's gone. It sounds simple. You got to be really careful with your underwriting if you want to get into the preferred equity place. The other thing that a lot of people are targeting, which I'm kind of excited about, I think industrial still has some legs, especially the higher end industrial. A lot of people are looking at industrial outdoor storage, which is like parking lots for trucks, because what's really interesting, which is a really cool asset class, is that a lot of these distribution centers underparked their facilities and especially didn't account for all their trucks for distribution. So what's interesting was now there's a lot of institutional players in there, but there was a real inefficiency in the marketplace up until a few years ago where you could buy at an 8-9 cap. And this is, again, with low interest rate environment still. You were getting like a target credit because they were ready, the trucks that you, for an 8 cap, that if it was an industrial building, you're paying a 4.5 cap. So there was a really cool arbitrage in that space that we've looked at. But I think what we'll see, I'm excited. But again, I have mixed feelings because I don't want to see people get hurt. But I do think that there will be great acquisition opportunities probably second quarter next year. I think the Feds are going to raise the rate again. We have this crazy anomaly right now. Inflation is being very stubborn because, unfortunately, whatever, not to get political, but because of our lack of immigration, the lack of people, we have the bodies to actually work in our workforce. What's the most critical thing on inflation is wages. And that's a pure supply and demand issue. So even though the economy sucks, there's such a demand for people because there's such a shortage. We're not stabilizing wages. And the only way we can do that is obviously with smart, either disincentivize the people who are not in the workforce to come back to work, or bring in, responsible immigration policy to bring people in who do want to work and meet the demands of the supply, the demands of labor that we all desperately need.
Absolutely. And well stated. I really like the way you blend it all together. The macro, the micro, the deal opportunities. We call this podcast the Dealmaker's Edge, which is clearly listening. You can understand your edge. Very quick thinker, very sharp, analytical, thoughtful, conservative about your underwriting. But there's also the mental aspect. Every day you've got a lot on your plate. You talked about how your father would only develop nearby, so he's around with the kids and so on and so forth. It's a new world. I'm sure you do a fair amount of travel. You've got a lot of responsibility. We've talked about that offline. You're clearly talented. You've got a long runway ahead of you. You've got a successful track record behind you, but there's got to be days where you're just, those tough days. Everybody has them. What are you telling yourself on those days as you're powering through? A lot of people listen to this maybe just early or on in their career in real estate. It's obviously a very long-term horizon, but what are some of the things you talk to yourself about when you're having, maybe a deal didn't go as well as you would have liked, or construction job? I mean, there's no construction job in the history of the world that ever went perfectly well. So how do you talk yourself through those stressful moments as you're continuing on throughout your career? I think that'd be great to hear.
Yeah, we're kind of touching on another subject that I'm really passionate about, which is mental health.
Yep.
And it's critical. First off, it's not a sprint, it's a marathon. For somebody like me who has ADD and it's hard for him to sit still for a long period of time, it took a tremendous amount of training and understanding, especially in the real estate profession. This is not a get-rich-quick strategy. If you want to do that, be a day trader. Go to Wall Street. You're moving money a lot quicker, a lot more stimulus, and you can get richer a lot quicker, maybe even easier. Real estate is not sexy. Real estate it's always hurry up and wait. Because the other challenge is that traditionally with real estate, whether you're acquiring an asset, developing an asset, there's multiple parties involved. And trust me, they're all working at different timelines and different priorities than you. So one of the initial struggles in my career was understanding that patience and understanding the marathon versus the sprint. That's just the overall, I think, thing for real estate that you have to get used to. In terms of balancing stress and things like that, meditation is incredible. I try to do that every day. I do sauna and cold plunge. It's really important because your mental health is just as important as your physical health. So just like you go to the gym, you really need to clear that out because stress can kill you. Stress can make you sick. And you really need to be clear-headed when you're making decisions. And because if you make the worst decisions I ever made in business are when I'm emotional, if I made them out of emotion, because emotions are rational, you really have to take the emotion out of business to be successful as well. You could be passionate, but not emotional. So those are some of the things that I think are really important to do. And I think also your end game can't be just to make money. I think that's not going to make happiness or you to be a successful human. I think whether that's to make money to give more charity, whether it's to create beautiful places in communities where you're impacting people's daily lives, which I really enjoy. I get a kick out of seeing a family take a family photo or wedding photos, and whether it's in our lifestyle centers or people who've lived in some of our residential properties for decades, and this is their home. It's a tremendous responsibility as a real estate owner, as a landlord. You're impacting human beings. You can't view it just as on a number basis. You have to view it holistically like that as well. You need to find that purpose within what you do. Otherwise, I believe you burn out. It's not sustainable. So yeah, I think that those are some of the things that I like to do. And then I also just love learning. So I think always being curious, to be consistent, to go full circle, to be growth oriented. Always approach the table like you're not the smartest person around the table. I always want to be the dumbest person in the table. I always want to learn from somebody else because otherwise I'm not growing. I'm not getting better. Our culture here is we don't want an echo chamber. We want to have respect, but we want to challenge and stress test every solution, every problem, because that's how you get the best results.
Absolutely. Well said. Ezra, I got to tell you, it's been a wonderful conversation. We touched on one of my favorite subjects too as well. And I had to get that in there, the mental health aspect. We all have mental health issues if we're alive on this earth today. And of course, tracking your exciting career to date, projecting out the future. Anything else I could have asked you, but I didn't ask you would have wanted to address, or I guess we can wrap if you'd like.
I think you were pretty extensive. I think we covered a lot of topics. I hope you found helpful or interesting.
Absolutely. Well, I really enjoyed it, and I know the people listening will get a tremendous amount of enjoyment around it, and education too. To see the balancing act that requires the nuance and the subtlety and the balance that you bring every day. But again, I just want to thank you for being on, making the time. You're a very busy guy, and I really appreciate it, and looking forward to watching a lot more success from you and your team in the near and foreseeable future, Ezra.
I really appreciate it. I appreciate you having me on.
All right, we'll wrap right here.
Thank you for joining the Dealmaker's Edge. Don't forget to follow us on your favorite podcast platform. Give us a 5-star rating so more people can follow the conversation.